The dogs of the Dow provide solid options for income investors. The 2023 dogs of the Dow are the highest-yielding stocks in the Dow at the end of 2022. Verizon. Verizon stock is undervalued and sports a decade-high dividend. Walgreens Boots Alliance. A new CEO is helping Walgreens Boots Alliance stock. Intel. Intel is just starting its big turnaround. International Business Machines. IBM is a dividend aristocrat. Amgen. Acquisitions are setting up Amgen stock for the future. Let's dive in. Here are the dogs of the Dow 2023. 5 dividend stocks for income investors. Welcome to Timely Investment Research. The start of the year is a good time to add to your existing portfolio or start new positions. An excellent source to look for ideas is among the dogs of the Dow. These stocks are the highest-yielding ones in the Dow Jones Industrial Average at the end of the preceding year. The strategy assumes the stocks are temporarily mispriced, and thus the yields are high. Additionally, the dogs of the Dow are blue-chip stocks with sustainable growth and excellent reputations. Hence, they make good picks for income investors. We emphasize dividend yield, conservative payout ratio, and valuation in our 5 picks. These 5 stocks make great choices for investors seeking higher yields at a reasonable price to generate dividend income. Number 1. Verizon. Verizon continues to be a consistent theme in our selection because of the combination of nearly a decade-high dividend yield and significant undervaluation. Few stocks offer both at the same time. For most of 2022, Verizon was challenged with growing its retail cellular subscribers. But a recent statement by the chief executive officer suggests the trend may have reversed in 2023. Also, the firm is reducing capital spending and cutting expenses. This is good news, and investors bid up the stock price off its lows in response. Still, the stock is yielding more than 6.5%, well above the 5-year average and more than 3 times the dividend yield of the S&P 500. Verizon increases its dividend by about 2% annually and has done so for the past 19 years. The dividend is supported by a payout ratio of only about 49%. Verizon is dirt cheap, trading at a price-to-earnings ratio of only 7.7x, well below the 5-year and 10-year ranges. As a result, Verizon is an excellent choice for investors seeking income at a reasonable price. Number 2. Walgreens Boots Alliance. Walgreens Boots Alliance has been on the dogs of the Dow annually since 2020 because of its recurring high dividend yield. The pharmacy retailer has struggled with low growth, opioid lawsuits, and more competition. In addition, the 2015 merger between Walgreens and Boots Alliance caused difficulties. That said, a new CEO is seemingly executing better. She also has a vision for expanding into healthcare. Along these lines, VillageMD recently acquired Summit Health for primary care, Shields for specialty care, and CareCentrix for post-acute care. Whether this strategy will work or not, though, will take time to determine. In the meantime, investors are paid to wait with a roughly 5.4% yield supported by a 42% payout ratio. Walgreens is not far from entering Dividend King status with 47 years of increases, but the dividend increase rate has slowed. Walgreens is trading at a low earnings multiple of 7.9x, below the 5-year and 10-year ranges. However, despite the near-term difficulties, the company is consistently profitable. Number 3. Intel. Intel is having one of its worst stretches since the dot-com boom between the company's missteps and a changing competitive environment. The company has faced difficulties shrinking its fabrication lines to 7 nanometers and 4 nanometers, causing them to fall behind Taiwan Semiconductor. Next, the ARM-based chips produced by Advanced Micro Devices are eating into Intel's PC and server market share. Intel designs and manufactures its own chips, while AMD designs and outsources manufacturing to Taiwan Semiconductor. Lastly, clients are increasingly developing their own chips and outsourcing manufacturing to fabs like Taiwan Semiconductor or Samsung. The result has been shareholders selling Intel stock, and the stock price has dropped to levels last seen in 2014 to 2015. Simultaneously, the dividend yield has soared to more than 5%. That said, Intel introduced Sapphire Rapids in its Xeon series of chips for data centers. Next, Intel's impending launch of Intel 4, 7 nanometers fabrication will make the firm's chips more competitive versus AMD's chips. Finally, Intel is spending tens of billions of dollars to expand its fab services with new plants in Arizona and Ohio. Intel's turnaround is still in the early stages, and the market hates the company, but the high demand for chips should be a tailwind. With the highest yield in a decade, combined with a reasonable payout ratio of 51%. Intel stock is a solid choice. Number 4. International Business Machines. International Business Machines is another company investors love to hate. But the firm performed better than its peers in 2022, and momentum may continue into 2023. International Business Machines started its turnaround in 2019 with the acquisition of Red Hat, moving definitively into hybrid cloud. Subsequently, a new CEO, followed by separating the managed infrastructure business into Kyndryl, has refocused the company. Today, IBM is about software, consulting, and mainframes. The firm is a leader in mainframes, hybrid cloud, transaction processing, and global consulting. That said, IBM has room to improve revenue growth and margins. The dividend yield of 4.7% is among the highest of the dividend aristocrats, making IBM attractive. The firm is committed to the dividend and is one of the longest-paying dividend stocks. Also, although the current raises are meager, IBM raises the dividend annually. IBM is undervalued compared to its peers based on the P/E ratio combined with a reasonable payout ratio of 51%. Intel stock is a solid choice. Number 5. Amgen. Amgen's stock price continues to trend up after some weakness during the COVID-19 pandemic. The firm has several blockbuster drugs with billions of dollars in sales. But investors were worried about patent expirations and rising competition from biosimilars. The company has dealt with challenges to its product portfolio by acquiring the oral immunology drug Otezla to complement Enbrel. Moreover, Amgen has pursued a strategy of acquiring smaller companies and gaining access to new molecules, compounds, and therapies. Since 2021, Amgen has acquired ChemoCentryx, Tenebio, and 5 Prime Therapeutics in multi-billion-dollar deals. Recently, Amgen announced the nearly $28 billion cash and debt deal for Horizon Therapeutics, growing the portfolio with the Tepezza blockbuster drug, several others with sales, and a robust pipeline. Amgen is yielding 3.2%, and the dividend is growing at a double-digit rate. Future growth is supported by a moderate payout ratio of 42%. The stock is probably fairly valued, but a successful acquisition of Horizon could mean future growth. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.